senior year of college, I had a little bit more money, $5,000, and I came across shorting. I mean, I realized that, you can bet stocks go down. So instantly right there, I kind of created, found my niche. In my senior year of college, I turned $5,000 into $1 million. I lost 500,000 really quick. I had the mindset when I graduated from college in May with $1 million. I thought, okay, that June, July, August, I want to finish the summer with 3 to 4 million in my account. I mean, there's no doubt I am addicted to the stock market. My chapter in the Market Wizards, it was almost called the Addicted Trader because we talked about addiction a lot. I realized right then and there that I didn't even have to take on more risk. I didn't have to double my position size. If I just try to cut out the garbage, cut out all the excess fat, whatever you want to call it, to my trading, that it can help my profitability grow dramatically. So I shorted a common right around $1,025 a share ish. I added more around 1,000. I added more around 985. I started covering the stock in the low 900s, and it actually went down to close at the low of days of around $800 a share. As you can see right here, it's split adjusted for 80. And this is another really good example of playing both the equity and the options here. This move happened on a Thursday, but these options here went up, I know, well over 10x. Study your biggest losses. Know what did you do the night before? Did you drink too much? Did you go to bed too late? Did you have some event happen in your life? Maybe a death of a loved one or whatever that might be, where you say, wow, I didn't trade that well that day because I did this or this or this, and take notes of that. Take mental notes. I have extreme risk management where if I enter a stock, I almost expect it to be green immediately. And I think that's one thing where some traders maybe rush into an entry. I think you want to wait for your entry so you're green immediately. If you're going to draw down 5% or 10% of whatever that is, I always size down my position sizing. When things are going good, I'm a big proponent of pushing that capital in. And when things are going bad, I back up. I immediately back up.
Hey everyone, welcome back to another episode. As always, we bring top traders, US investing champions, and market wizards here onto the show to share their journeys, their strategies, the mistakes they made throughout their careers, and key learnings that they want to pass on to you guys to save you time, save you money, and improve your performance. We've been lucky enough to hear back from many viewers over the past few years about how much of a positive impact this podcast has had on their trading journeys, and we're incredibly grateful for all the support. If you're looking for a free, quick, and easy way to give back to us and show us some goodwill, please double check that you're subscribed down below. And if you aren't, go ahead and click that button. And if you have any suggestions for traders you'd like us to bring on the show, also let us know down below in the comment section. And with that said, thanks again for your support, and sit back, relax, and enjoy. All right, welcome back everybody to the TraderLion podcast. I'm your host, Richard Moglen. This episode is brought to you by DeepView Charts. Check out the link down below in the description for a special offer on the best platform for swing and position traders, and to also check out the new DeepView AI. Joining us today on the podcast is Phil Goedeker, a full-time trader with over 20 years of experience. Phil is featured in the upcoming Market Wizards book by Jack Schwager and has traded 5K into over 50 million during his career. Today, we will dive into his edges and how he's achieved super performance, but also importantly, we'll cover what he calls extreme risk management and protects his portfolio. Phil, great to have you here. Welcome. So honored to have you here. And yeah, great to have you on the show.
Richard, I'm happy to be here. Love chatting with you. It was great to meet you this weekend in Miami. So this is kind of a good follow-up. I appreciate you asking me to be on.
Of course, my pleasure. To start with, I would like it to bring it back a little bit to the beginning of your trading career.
Sure.
Obviously, you've been trading for 20 years. A lot of people, because it's just a natural trader's journey, struggle a little bit at the beginning. I'd love to hear for you, because I know you're mostly self-taught.
Right.
What were some of the key turning points in your trading journey, discovering your style, aha moments where maybe it was a trade, maybe it was a period where basically you turned the corner and, took a firm step towards strong performance and profitability?
Sure. So first of all, I want to, admit I'm a short seller. I've been really a short seller for about 20 years. So when I got interested in the stock market, it was late high school, early college, and I opened up an account my sophomore year of college. Just had like $3,000 that I made from working over the summer, and I was basically a long swing trader. It's about all that I knew how to do. Slowly lost that money. Junior year in college, did the same thing. Had about $3,000 from working over the summer. Slowly lost that money. swing trading. And during this time, I was doing a lot of technical analysis, just studying charts, studying patterns, studying charts, studying patterns, looking at the big winners, trying to decipher what will be the next big winner. And I had no success. So my senior year of college, I had a little bit more money, $5,000, and I came across shorting. I mean, I realized that, you can bet stocks go down. So I instantly kind of flipped my strategy right then and there to find stocks that I thought went up too much, too fast, too high, and bet that they would go down. So instantly right there, I kind of created, found my niche. In my senior year of college, I turned $5,000 into $1 million. So I was instantly hooked as a short seller. That was kind of my new found niche, my edge, and what I went ahead doing really, almost since day one.
And were they small caps that you were shorting, penny stocks? What was kind of the genre of stock that you were
Most
short
of them,
selling?
most everything is a small cap, a mid cap, something under, $20, $30 for sure. And they were swing trades. I mean, I wanted to find a stock that had run up 1 week, 2 weeks in time, peak out, and hopefully swing trade that 3 days, 4 days, 5 days, possibly even 2 weeks, where it gave back most of that move. That was my niche. That was my edge. At that time, I really didn't day trade any stocks on the short side at all. It was strictly swing trading. And yeah, most of them were lower priced small caps.
Yeah. And during that time, obviously you had your ups and downs
Right.
there. This is a question, I asked folks, what would they like to ask you?
Sure.
And a lot of them were asking about what kept you going, what kept you driven to try to figure out a way for you, what kept you motivated during when times were tough, when you're in drawdowns, especially earlier in career, when you
Right.
haven't really had that success yet.
Right.
What do you think did it for you that let you keep going and keep persevering?
I think a lot of it is just discipline and the ability to just say, no, I'm not giving up. I mean, I will figure out what it takes. I mean, at the time, I did watch CNBC a little bit. I did read articles. I read the newspaper, how much people were making in the markets, whether they're, just even, money managers or individual investors. So I knew
To
the
see what's
potential.
possible.
I knew the
Yeah.
potential was out there to make big money. And not being disrespectful to any of those people, I thought, these guys are not smarter than me. I mean, at the end of the day, this can be figured out. So, I looked at it as two ways. I can either sit and figure it out, and I put in a lot of time. I mean, I'm not going to lie. I put in, 8, 10, 12 hours a day, 6 days a week, year after year after year. But I knew it's either that or, going to get a different job. I mean, you got to go to work, 9 to 5 and make, most likely a fraction of what I was making in the market. So, to me, there was no option of giving up. There was no option of quitting. It's like, I'm going to figure this out no matter what it takes. And, I had a lot of, so many ups and downs. I mean, I still have ups and downs, even though I've traded 20 years. I mean, it's not all up.
Yeah.
I have a lot of downs, even today. I mean, but it's willingness to really study those trades and figure out what you're doing well and try to keep compounding that and figure out what you need work on and keep trying to grow that edge, to grow that niche into, just being the best trader you can be. But really, it's a strong mindset. I think that's one thing that's helped with 20 years is a strong mindset to just win at, I don't want to say any cost, but, it's going to put in time and going to put in effort. But I really think that if people put in that time and effort, I think it's, it's going to pay off for you.
And if you had to start over today, like you've talked about, you're mostly self-taught.
Right.
What resources would you want to start with today if you were completely starting from scratch?
Right.
What resources would you recommend to a friend who wants to
Sure.
get into trading now,
Sure.
to help accelerate? Everybody has to go through, like, there's stuff you have to learn for sure and experience, but what would kind of set them on the right path, do you think?
So, when I started trading 20 years ago, there was no X, Twitter. There were no, to my knowledge, there were no really trader meetups or get-togethers. I'm sure there were. There were just maybe, I just wasn't around that. So I had Yahoo message boards, which was, just complete garbage and trash. So today there is so much more information out there. So what I would do is I would follow some of the smartest people on X that you can follow. Someone that puts out ideas. Now, the thing is, you don't want to just blindly follow someone else's, thoughts or trading style, because everyone's going to have their own trading style, and you can get mentored by the best trader in the world, and it doesn't mean that you are going to duplicate their results. I would argue there's no way to just duplicate someone else's results. But what I would do is I would try to surround yourself, number one, on social media through the best traders out there. Number two, do, try to go to, if you can, try to meet up with other traders. We just had a Traders for Cause event in Miami. That's fantastic. There were almost 350 traders there from around the world. And if you can just meet a few people, chat with a few people and say, hey, what do you do? How do you make money? And then just kind of study their pattern, look at their pattern, see what they do, see how they did it. It might work for you. It might not work for you. But I think along the ways, if you can pick up little bits and pieces of information from other knowledgeable traders, it's going to help you. And that's one of the great things about trading. There are so many ways to make money. You can be long biased, you can be short biased, you can trade large caps, small caps, mid caps, options, equities, futures. I mean, there are so many ways. So I always tell somebody, don't look at somebody else's method and say, I'm going to do that. I have to follow that. Look at somebody else's method, pick up bits and pieces and see if it works for you. But there's a lot of information out there that can be helpful to new traders. There's no doubt.
Yeah. And when we were talking in person, we talked a little bit about, how many charts you've looked at and studied and and how that was really helpful for your development.
Right.
So were at that time when you were really figuring things out, were you just looking at a lot of successful short sell trades or possibilities in the recent market period and historically? What were you doing to kind of study? What charts were you looking at to
so
develop
my whole
edge further?
background has been technical analysis. I would say I'm 95% technical analysis, 5% fundamental analysis. So getting started, I wanted to find the biggest winners. What was moving? What was causing a stock to go up 400% in a year, 500% in a year, 600% in a year. And I would just look at those charts over and over and over and over again. And what I did is I looked at those charts during the beginning of that move, like the first 30 days. And then I would look at that chart maybe 3 to 4 months in, and then I'd look at that chart at the end of the move, which could be a year, could be 2 years. Every setup is just completely different. But what I tried to do was look at the chart and see what makes a stock go up as high as it does and try to figure out those patterns. So again, early on, like I said, a lot of my success or almost all my success was on the short side. And a lot of that was just because of patience and discipline. Yes, I could find a stock that was breaking out on heavy volume, but I did not have the patience to hold it a month, 3 months, 6 months, 9 months. I mean, I had the patience to hold a couple days. That was it. And that's why on the long side, I just did not have that success. Where on the short side, with small caps, I did because you had such violent, aggressive moves. I could get, some extreme profits in just 2 days or 4 days or 5 days or whatever it took. But a lot of it was, just repetitive studying charts over and over and over and over again and trying to develop those patterns to hopefully find the next setup. Yeah.
Hey everyone, just want to jump in here real quick and let you know that this episode is brought to you by DFU, which is the platform I use every single day to find new trading ideas, monitor existing positions, identify new leading themes, and analyze the markets. You guys deserve a platform that keeps innovating and brings you the most up-to-date tools to trade the market. And at DFU, almost every single week, we're launching a new feature or system update. Here's what makes DFU different. The screener comes loaded with preset screens from actual market wizards and top traders. So you're starting from the setups that the best in the world actually use. And when you're flipping through results, you've got mini charts right there, so you can visually scan through hundreds of stocks all at once. That alone saves me so much time every single week. The charting is built for how we actually trade. Multiple timeframes, unlimited indicators included anchor VWAP, enhanced volume, custom indicators like RMV, and the built-in RS rating. You've got custom dashboards to track the market, themes, and real-time sector rotation, so you always know where the money's flowing. Best yet, we just launched the DFU AI terminal, which brings all your research into DFU with easy-to-use preset prompts or your own custom ones. You can even identify gap catalysts with just a right click. We set up an exclusive offer of 1 free month for all TraderLion podcast listeners. So to activate your trial today, check out the link down below in the description or visit dfu.com/podcast. That's dfu.com/podcast. And with that, let's get back to the interview. When we were talking a little bit earlier, you talked about like a little bit further on in your journey, you were doing well, but you weren't quite getting that next level of success.
Right.
But you talked about how helpful it was to look back on your trades, see where you were actually getting the Pareto principle, most of your profits from,
Right.
and trying to eliminate those C and D type trades. Could you talk a little bit about that process?
Sure.
First of all, how do you identify what an A+ setup for you looks like?
Right.
And how you develop the discipline or process to just try to focus on those
Right.
and reach that next level by trading less of the bad stuff that actually doesn't help performance
Right.
and often hurts it.
No, absolutely. So my first 3 years of profitability, I did very well. I mean, it's well into six figures, more than I could make in any other job. But by year three, I'm like, okay, I need to break out to the next level. I want to hit, the $1 million mark. And I thought, well, there's two ways to do that. I can either double my position size, which should double my profits, or, I guess my wake up call was at the end of year three. I looked at my tax return and I looked at all of my trades, and I don't remember back then, but I'm going to say there were maybe, you know, close to 1,000 trades that I made. And I went through all of these trades, and I can remember maybe 24 of them, all with big money. I made 75,000 on this, 100,000 on this, 45,000 on this, 80,000, whatever those numbers are. And I remembered all those setups like they were yesterday. They were big winners. And then I went through, I continued to go through, and I thought I lost 25,000 here, 30,000 here, 40,000 here. And I thought, I don't even remember any of these setups. I thought, why would I have even placed that trade? Why did I do that? I don't remember that ticker. And I went back and through and I looked at all those charts. I said, did that meet the criteria of a good trade? And no, it did not. It met the criteria of a boredom trade. It met the criteria of me sitting in front of my computer without much to do, thinking, well, this looks okay. Let me give it a try and see what happens. And I realized right then and there that I didn't even have to take on more risk. I didn't have to double my position size. If I just try to cut out the garbage, cut out all the excess fat, whatever you want to call it, to my trading, that it can help, my profitability grow dramatically. So year four, I did that. I increased my position size, maybe 10%, which is what I was comfortable with, but I cut out all those extra trades, which were a B setup, C, D, whatever you want to call them. And my profits doubled. I finally hit my first, $1 million year in around year four, right? And that was just a monster wake up call, to me to, just cut out all this excess. Now, it is so hard because as a day trader, we're all, thinking that we have to trade every day. And most of us do. It's just, I think you really have to watch out your position sizing. So, when you asked what constitutes an A plus setup, so, an A plus setup, I think, is going to differ for everyone, right? Because we all have different trading styles, we have different time frames, et cetera. So my A plus setup was, a small cap that had run up, maybe a week or 2 weeks or whatever it was. And it had that first, maybe a first red day, or it started to really break down in heavy volume. And I think, okay, the buying here is done. The tide is going to turn. This stock had no news, so that's where my 5 or 10% of fundamental analysis kicking in, that there's no reason for this move to happen. And I think it's going to crash or correct, correct 20%, 30%, 40%, 50%. So that for me would be an A plus setup. And, I found, through my career, I find, a couple a month, maybe one a month, maybe two a month, maybe, depending on the market you're in. But again, if you're saying that a setup occurs once a month or twice a month, then what do I do all of those other days in a month? Well, I'm still sitting at my computer, 8 or 10 hours a day. So you're going to kind of boredom trade and place all these trades that you really shouldn't be trading. So, I think if you're going to do that, you just have to do it with extremely small position size, where the profit and loss on those is going to be meaningless, because it's most likely, if you're trading something outside of your niche, they're going to be 50-50 trades. So anyway, that was a big wake up for me to just realize, hey, this is where I make money. This is what I'm good at. All of this other stuff I'm not good at. So either cut out all those trades, or continue to learn if you want to try to, keep going with stuff, but just do it with very minimal position sizing while you're trying to learn, that type of stuff.
So at that point, you were doing about 1,000 trades a year. What do you think typically now later on in your career you're doing? I know you're almost doing this more part-time and selective when the setups happen, but yeah, how has the number of trades you've taken each year, what's that trend been like over your career?
I'll be honest, the amount of trades is probably the exact same, but if you would look at the position sizing on my trades, you would see a massive difference. I mean, you would just see a massive difference. So again, there's no doubt I am addicted to the stock market. My chapter in the Market Wizards, it was almost called The Addicted Trader, because we talked about addiction a lot. And addiction has a very negative connotation, obviously, for several reasons. But, being addicted to the stock market is a tough thing to just sit there and have the patience ability to not do anything. So yes, I am definitely trading less today than I did back then, 100%. But if I'm still putting on a lot of trades today, there will be a significant difference in the position sizing that I have, because I know
Right.
that, A plus setups are where I make my money. And I know they're always going to occur. I know that sometimes in different markets, it might be slower. There might be one a month, and then the next 2 months, there might not be anything. And then the next month, you might have two. So I know they're always going to occur, and I have the patience to wait for them. And in the meantime, yeah, I still fiddle around with different techniques and different things. I still try to, become a good long bias swing trader. I mean, I do that. I do it with very small size, because I still know, even after trading 20 years, I don't have the patience yet to really just, hold some of these things. So it's still, I think traders, even experienced traders, are always learning. It's not like you just hit something and say, okay, I've traded 10 years or 20 years, or I've made this amount of money, I know everything out there. No, I mean, all the traders I talk to, no matter how long they've been in the market or how much they've made, they're always tweaking their strategy. They're always adapting. They're always trying to, perfect their edge, or whatever you want to call it.
Yeah. And one thing I was really curious about is how concentrated were you throughout your career as well? So like how much did you risk per trade early on versus now later? Like you've talked about, it's much more dynamic, where the A plus setups are they're worth more risk because the potential is greater.
Right.
But over your career, how did that concentration change, if at all, and also that risk per trade change?
No, it's a really good question. So my senior year of college, when I turned that 5,000 to $1 million, I was all in every single trade, every single time. I didn't know anything different, 100% in. Now I want to follow up to that statement of, I did turn 5,000 into $1 million in as about 8 months, but the following 3 months, I lost 500,000 really quick. I had the mindset when I graduated from college in May with $1 million. I thought, okay, that June, July, August, I want to finish the summer with 3 to 4 million in my account. Well, the market changed a little bit, and maybe obviously my knowledge was not that great, so my $1 million went down to 500 really quick. So that was a great lesson in money management. So I wired out 400,000, started trading with 100 right there, to kind of just protect myself. So really, even the next couple of years, if I was going to be in a position, it was mostly all in. But again, it was all in with a much smaller account. It was a $100,000 account. And what I did, and what I've continued to do for 20 years, is wire out at the end of the month. So when I was trading, at the age of 22 or 23, if I had 100,000, whatever I'd make at the end of the month, I wired out, whether that be 30 grand, 40 grand, 50 grand, wired it out, put it in the bank, or alternative investments. So for several years, now I did continue to grow my account, during that time, but I've always been somebody that wires out. So when, when I had that account of 100,000, or, a few years later, 200,000, I was still going almost all in on a lot of trades. But again, all in meant all in my trading account. And that number over the years slowly got to be a smaller and smaller percentage of my net worth.
Your total.
So if I say all in, it's not all in on my net worth. It's all in on my trading account, which is a fraction of my net worth. And that honestly really helped me, because, I realized that, if I ever felt pressured in my early days to make money, like I need to make money today, or I've got to pay this bill, or I want to buy this, I would lose every day. One thing that helped me throughout the years and helped me have success is when I go to my computer and I have a free and clear mind that if I make money, great. If the setup is there, great. But if I try to push things that are not there, it turns out to be really bad. So what really helped me is continuing to wire out, continue to put money in alternative investments that were growing, and knowing, not that I would ever want or expect a blow up of my trading account, but if I lost some of my trading account, it would be okay, because I have these backups. So now as I continue to grow, and I went on to have, like a 7-figure trading account, I'm not going to risk all that. The percentage of my account that I would be willing to risk would be much, much, much lower. But if I would go all in on a trade, let's say I had $1 million account and I go all in on $1 million, I'm not risking $1 million. So one thing that has really helped me, and maybe you're going to touch base on this a little bit, but I have, extreme risk management. So if I could go all in on $1 million, I'd be willing to lose maybe, again, every position is different. It's hard to say, but maybe 20, 30, 40,000, 50,000, 5% of that would be the max, where I said, hey, this is wrong. I mean, my entry was wrong. I mean, this is going the wrong way. I'm getting out, and I can easily get back in that stock. but I would never just say the mindset of, well, I'm going to, go all in and see what happens. So I mean, I have extreme risk management where, if I enter a stock, I almost expect it to be green immediately. And I think that's one thing where some traders maybe rush into an entry. And we've all done it. I mean, okay, it's human nature. So of course I've done it, but I've tried to really be patient, wait for my entries. And again, I think you want to wait for your entry so you're green immediately, right? And if we're
Yep.
wrong immediately, you know, don't freak out, don't panic. But once that gets to a certain amount, don't add to that. I've been a strong proponent of not adding to losing trades over the years.
It's amazing how my best trades from almost minute one, and I'm a breakout long bias trader, they're green and they're green the next day. And then that is like, those are the A plus, that
Yep.
those are the ones that really move the account, is the
Right.
ones you're right immediately on. And like you said, if it's going against you, you have to have a point where you cut the loss, because it's negative feedback. You're not being rewarded for the money you're risking. So I think that's
Right.
super important.
Right.
One question I had for you, Phil, was do you pyramid into a position, or do
Yes.
you go all at once
No,
into it? Yeah.
it's so weird. I was almost going to interrupt and say, let me say, if I went all in, I absolutely pyramided into a position. So,
Right.
now again, 20 years ago when I was starting out on some of the smaller accounts, no, I would just go all in. But once I started to build the account by year 5 or 6, and that account got up near 7 figures, I would always take a starter size, whether that be a 4th position, a 5th position, a 6th position. And like I said, then you want to give it some time. So,
Right.
and you give it that small position. So if you have to take that loss and that entry was wrong, you're only risking a small part of your account. Because again, as day traders, we all realize, I mean, even me, throughout the years, I mean, my win-loss rate is, I'm not saying it's 50-50, but it's, I have a lot of losses. I do. The difference is I cut my losses very quick. And I've been, a strong proponent of adding when you're green, adding when things are right, adding when the trade is going with you, certainly not adding when the trade is going against you. So strongly recommend pyramiding into a position all the time.
One other question I had, Phil, was like, what is a typical drawdown percentage of your account
Mhm.
now? And also going back in the past when you were more aggressive, it seems like, and
Mhm.
a little bit more of a cowboy, even though
Yeah.
it sounds like you're still more of a cowboy. What were the drawdowns like that, and how did you handle that psychologically? Like you've talked about, you had that buffer of knowing that your net, like not all
Yeah.
your net, you're not trading your net worth,
Right.
right? You've got a smaller portion, and that helps. But yeah,
Right.
what were your drawdowns typically like?
I was fortunate enough throughout my career to not have massive drawdowns. Now, I've had some big losses, so I can remember a couple of them throughout the years. Like I believe it was in 2018-ish, could have been 2019. I lost, around $1 million shorting Drys, Dryships, and then they announced some, toxic financing, and I made all that back. And then on GameStop, shorting GameStop, I lost around $2 million, and I made, most of that back on the backside. Um, Percentage-wise of my account, both of those at the time were probably 50%, and
Wow.
those were the biggest two that I can ever remember. Right at 50%, and I, again, it really helped me throughout the years to continue to wire out, put money in alternative investments, where if you had a drawdown, it psychologically didn't burn you too much. Other than that, my drawdowns 5%, 10%, and if I ever got, I think, one of the most important things people need to realize in a drawdown, why are you having a drawdown? What's going on? So obviously, the market conditions are changing to something that you were used to. And if that's the case, if you're in a drawdown 5% or 10% of whatever that is, I always size down my position sizing, no matter what. Even if I saw an A plus setup, I'm like, hey, things are maybe working a little different. Instead of putting in, risking this, I'm going to risk, 25% less. So whenever I'm in a drawdown, I just size down until I'm back making that money back on a good cycle. And then I push it hard. When things are going good, I'm a big proponent of pushing that capital in. And when things are going bad, I back up. I immediately back up. It just sets out a red flag if something's not right. And it could be something's maybe not right with you. Like, do you have a lack of sleep? Are you dealing with some event outside the market that's letting you maybe not think clearly? Or do you have something else on your mind? Or like I said, are the market conditions changing? Whatever it is,
Right.
if you're in a drawdown, I just strongly recommend sizing down your account until things change to get back on track.
Do you have a rule for yourself? If I'm down, if my account's down 5%, 10%,
Mhm.
I'll take half position the next trade, or it's a little bit more fluid than that. But that's the general idea, right?
That's the
Sizing
general
down.
idea. I
Yeah.
don't have
Yeah.
really any hard line rules like that. It's all mental for
Hmm.
me of just I know when things are going well, I know when things are weakening, and I know when to push and I know when to just back up. And I think any seasoned trader, hopefully should know that in the market because again, as the market goes through cycles. The market goes through cycles where it's at times, I mean, this is infrequent, but at times it's almost like easy money. I mean, we've all hit those cycles. I mean,
Yeah.
back in 2020, we had the initial crash. The Fed flooded the market with liquidity and everything just ran up huge. I've heard so many stories about people making so much money in that market. It was kind of an easy market. And then liquidity stops a couple years later, 2022 bear market, things tighten up. Things are different. So you have to be able to realize and recognize when those patterns are occurring and when it's time to just back up. And that's, again, it's hard as a day trader because we're attuned to sit in front of our computers and push buttons and make money. And if the last 3 months or 6 months or 9 months were really good or easy, it's hard to next month say, wow, things are changing. But I've heard a lot of stories of people over the years that don't know when to back off. They just think, I'm going to keep pushing, I'm going to keep pushing, I'm going to keep pushing. Before they know it, their count is gone or it's blown up. And then how do you dig yourself out of that hole or start over? That's not an easy or fun process to do.
Yeah. And you brought up something that's really important there. Like the environment that you're trading in is going to have that's really going to dictate your performance. Like even if you're targeting the same type of trade in
True.
this market where that's being rewarded, it's going to do well. In a choppier market or whatever, a more negative market, it's not going to do well. So
Right.
for you, what are some of the things that you keep track of that say, like an A plus setup,
Mhm.
the market is an A plus setup right now. Like this is a
Right.
time where I want to step more on the gas versus,
Right.
all right, the market's deteriorating a little bit. I'm going to be more selective, more
Sure.
defensive here, not going to go as big. So yeah, how do you determine the market health for
And
you?
for one thing, I still wanted to follow up on that last question about the losses, and real quick, and then I'll
Yeah.
get to this one. Is that I wanted to mention, I forgot, but when you lose money, it sucks, right? We're in a drawdown financially; it is a tough time. But the financial side is okay. You lost 5 or 10% of your account, but I think sometimes what people don't realize is how tough the mental side is, and how easy that is to snowball. And I've just
Yes.
seen so many people that get down 10% and then just freak out and they panic. And now the next day they said, I got to make that back so I can get back on track. And they overtrade and they do things that they weren't supposed to do. So I think, that's one of the problems with losses and drawdowns. And that's why it's so important to walk away or step back or size down because the emotional and mental side is almost worse than the financial side because until you can clear your mind and get your mind back to where it needs to be, I don't know that you're going to reset yourself. So anyway, sorry about that. But to get back to your new
You're
question
good.
about, the A plus setups in the market, I think a lot of it depends on your performance. How are you trading? How do your P&L numbers look? So if you're making, through my experience, if I've ever making money, if I'm just making money day after day after day, and there's a lot of setups out there, I continue to push it. That's the
Right.
biggest thing. I mean, that's the easiest way to score ourselves as traders is with our profit and loss. Now, yes, there are times where, some bad trading techniques are rewarded, and that's obviously not beneficial to us. It's beneficial on the financial side, but not on the mental side. But overall, I think the easiest way is your scorecard. What are you making or what are you losing? And I think that's the easiest way to determine if we're in a good hot market for your trading style or if we're not.
Yeah, excellent. Phil, I know you wanted to bring up some case studies, and I'd love to go to that now. And I think that will kind of bring everything we're talking about together into real life. So
Sure.
feel free to share your screen and let's walk
Yeah,
through a few of these. And
absolutely.
to start with, before you go through the charts, I'd love to hear, how did these get on your radar in the first place? Because
Yeah.
obviously it has to get across your screen in the first place for
Right.
you to possibly trade it. So how did you find these opportunities? And we'll start with SMCI here.
Yeah. So again, throughout my career as a short seller, I'm looking for just overbought situation, something with just that's extremely overbought to the upside that I think is going to correct. And again, I've adapted from just small caps in my early days to now some mid caps, large caps, or whatever that might be. So anything that's in an extreme overbought situation is something I'm interested in. So we had that situation back in February of 2024 with super microcomputer. We had a run up in 2023. based out, broke out in heavy volume, looks like the 19th of 2024 before it just went completely parabolic up to around the 15th or 16th of February. Now, obviously, this chart is split adjusted, so when this trade
Yeah.
actually happened, SMCI was over $1,000 a share. So basically, you can see that, that climactic move, like I said, I think it's the 15th or 16th of February, where it runs up 3 straight days in a row. That fourth
Could
day,
you
it
point
opens
that
up.
out with your mouse?
I'm
Sorry,
sorry?
Phil. Could you
Oh,
point
yeah,
that
yeah,
out?
yeah, yeah,
Could
yeah.
you point that out with your mouse?
Yeah, so right about here, super microcomputer was on my radar here, but not, it didn't really reach extreme overbought situations until about right here. So on that third candle upside, I still had not even, honestly, I had not traded this stock yet. But when we got the gap up on, like I said, I think it was the 15th or 16th, I immediately thought, hey, the risk reward is just way too high. I mean, the RSI, the stock was in the high 90s. This was a Friday, and this was a stock that I actually traded both the equities and the options, and I will get into that if you wanted me to. So I shorted a
Yeah.
common right around $1,025 a share ish. I added more around 1,000. I added more around 985. I started covering the stock in the low 900s. And it actually went down to close at the low of days of around $800 a share. As you can see right here, it's split adjusted for 80. So, the reason I did both the equities and the options is that, in a situation like this, and these are tough. I mean, these are hard trades, is that, yeah, I mean, the stock fell and you could have made, 20 to, now, I don't know, 25% on your equity. Some of those options that day, those 0 day to expiration options probably went up, 60x, 70x, which I didn't catch anywhere near that, but I did catch a fraction of that move. So I traded both of them. So again, this is a situation for me overall that would be an A plus setup.
Yeah, so just to kind of say back what you said, you're seeing a stock that's already been in a momentum trend, and then the slope kind of changes. You're seeing multiple gap ups in a row, and then you had another gap up, and
Yes.
then that's what started the reversal. Did the $1,000 level, did that play into the A plus setup where you've got a kind of key level that's very psychological, or was that not really a part of it?
Not really. I think what
Mm-hmm.
made this an A plus setup as well was being that it was a Friday and this was a heavily traded option,
Mm-hmm.
uh,
So yeah, the
company.
weekly's
The options
expiring
were
too.
heavily
Yeah.
traded. So putting those two together, if I could go back and redo this, I would trade it way different, because even at the time, I didn't realize the potential of the move in the options. I mean, to make possibly 60 or 70x is something that you just rarely see, for something that is so thickly traded like this.
So what would you have done differently if you were
Well, if
going
I
back and trading
saw this
this?
setup today, I would take on, this was a 7-figure trade for me. When it was a, $1 million, slightly over that plus trade. So it's hard to complain, but again, I would take on probably at least 5x, if not 10x the position size on this that I did back then. Because again, I was, I've been an option trader for a while, more so of an option seller, not an option buyer. So I was a little unfamiliar with the potential move of some of those premiums. So again, if I saw something like this today, as a trader, anybody that trades 10 years or 15 years or 20 years, we all see these monster setups and we all know what they offer. And we all know, unfortunately, how kind of infrequently they come about. So to see a setup like this and say, wow, I mean, there's no doubt about this chart and this setup. It's going to correct, and it's going to correct hard. Now, did I predict it was going to happen on that day? No. I mean, could it have run up another day? Maybe, even though the RSI was overbought. But what I do know is that the potential on options to make such an extreme amount, you just don't see it that frequently. So it's not something that I could trade, every few weeks. I mean, these might be one a year, couple of years setup. So when you see something so infrequent, yeah, I would definitely increase my position size on that today.
So just to dive a little bit deeper into the entry, it had a gap up, and you're watch. Are you watching for a reversal? What time frames are you watching? What actually, are you looking at the prior day high as that kind of daily pivot? That if it breaks below that, that's the signal for you to get started. How did you actually kind of decide, all right, this is the time, momentum shifting, reversing to the downside. This is where I want to press my bets to the short side.
So there's a lot of indicators out there, I know, and there's a lot of good traders that use a lot of different indicators. I use price and volume. That is all I have ever used since day one. So I'm looking at the price, intraday chart, 5-minute chart, and I'm looking at the volume. And when I saw the stock open up around, I'm thinking this is a year and a half ago, something around $1,025 a share. It ran up to $1,050. And after about 30 minutes after the open, once it came down below its opening price, was a signal to me like, hey, okay, we could finally have some weakness here. And again, it was falling. It was selling off on heavier volume. So that was a sign to me that, hey, we need to get started here. We need to get started, put on a position size on both the options and the equities, and give it some time and see if we're right. And the time didn't take very long. Once it started to fall, it started to fall pretty fast. And I'm sure you've known after looking at the markets, a long time, is that, these stocks, yeah, they can move up fast, but the saying is, I think it's like an escalator up and an elevator down. So when they start to break, they're going to break quickly, and you need to be ready to add to that size. So my initial entry on this was probably about 1/5 size, but within a few minutes, I was going to 2/5, 3/5, 4, and I'm almost fully sized in on this setup, no longer than 30 minutes after my initial entry. Because once it started to break and once that volume started to increase, I thought, hey, this could be it. This could be a big, big, big win. And luckily enough, it turned out to be that. It gave back more than I thought. I mean, definitely, corrected more than I thought, but it was a good setup. Yep.
And for the sell here, did you close it all at the close, which again was at low of day, or did you look for fall through the next day with a portion of your position? How did you ultimately decide to sell SMCI?
Yeah, so I covered. I exited all SMCI that day. I had made, like I said, I'd made 7 figures. Wanted to just get out of the trade, and I didn't hold anything overnight. I thought there was potential for a little bit more, but something this volatile just wasn't worth it to me. It was worth it to just completely get out. So again, you asked me earlier about, do I pyramid in? So I do pyramid into positions, but I also pyramid out of positions. So I think my initial covers on this were around 900. So I probably took around a fifth out around 900. Same thing around 880s, 870s, 860s. I don't remember that I held anything less than 850 on that trade. Maybe a little bit. Maybe like I had a 10th size on. But I scaled out and I was out by the end of the day.
And is that typical for kind of these parabolic shorts that you're out that first day, or do you sometimes leave a runner for a longer swing trade short sell type trade?
And again, it's hard because every situation is different. So back when I first started trading, there were no borrow fees. There was no short interest. There was no locate fees. There was no borrow fees. So you could hold things as long as you wanted, and you would be charged nothing. That game has changed dramatically with free commission. So a lot of times borrows are expensive. Sometimes borrows are hard to find. They were not hard to find on this at all. They weren't, and they could have even been free on this stock. But if borrow costs are high and short interest are high, that's definitely going to be something in my mind where I want to hold that a day, maybe 2 days, a couple days, and it all depends on the float as well. This was a thick, this was an expensive stock, a thick float where it didn't have massive gap risk, but on a small cap with a possibly smaller float, it's a lot more risky to hold those overnight.
Yeah, perfect. And could you bring up SLV actually? Because this is kind of the most recent, similar situation to this. I don't know if you traded this, but one thing that was interesting with SLV, yeah, you did. Could you go to? Yeah, there we go. Maybe so an hourly. So we see the drop here. I mean, we talked about SMCI dropping fast. This one dropped like a rock right after that gap down. Yeah, break down this trade for us if you don't mind. How did you? I assume you were stalking this for quite some time, and this one, it was interesting because there was like a head fake short a few days earlier that recovered, and then it finally went.
So this was a trade. Full disclosure, I had on my radar for over probably about a month, right around Christmas time. I was shorting it, had some success, gave it back, and it was just kind of an up and down trade. Obviously, it's a commodity, so it's not going to trade the same. But this day right here was Monday, looks like January 26th. And this was the parabolic week where we started out, we ran up big into Monday morning. We cracked hard into Monday afternoon. And I thought that signal, I thought the move was going to be over, to be honest, right then and there. And I had a pretty large position size on, and I did make, very good money on that Monday. But then into Tuesday, we just held. It didn't want to break down. Wednesday we continued to kind of run up. And then into Thursday, we made, new highs, but then it cracked really hard. And then it
Yeah.
kind of rebounded again. So it was just such a tough trade that when it cracked and it cracked hard on volume, it just didn't want to give it up. It just didn't want to die. And the hardest thing for this trade forever was that when it opened up Friday, it had gapped down, what is that, 12, 13% or something around there. So that is a hard thing for a short seller to do, to short that gap. I mean, any other time in the past, you can look back through this chart that we had gapped down, we had kind of bounced or it had held. So, on this Friday, we just had massive liquidations that followed. And I think silver that day was down around 35%. So this was an A+ setup that I honestly did not perform on anywhere near my expectations. And I think part of the reason is that it is a commodity, it is a future, it does trade, all night. And I believe this was the day, that Parabolic day, that Kevin Warsh was announced to the Fed, and the dollar, bottomed and bounced really hard. So gold and silver both got crushed here, and then you had the liquidation. So that was definitely a tough setup on that silver day.
Yeah, those head fakes were tough, and it's interesting. Like from your perspective, it's much easier to buy on a gap up that reverses because you can manage risk versus that highs, versus something that's gap down and you're not sure if there's going to be a sharp recovery or follow through to the downside. Can you bring me into your head a little bit about how you think about that?
Yeah, absolutely. It's a great question. As a short seller, it is so much easier to have a gap up, and short into that than to try to chase a gap down, because it's just the way the market operates. I mean, you're kind of giving up some of that potential when something's already drops 12 or 13%. A lot of times, again, a lot of times too, through my trading, through my technical analysis, I'm looking at the daily chart, but I'm also looking at the monthly chart, 1 month out, 3 months out, 6 months out. And I want to see, how did that stock trade when it gapped down? And again, a lot of times, you look at silver, it had bounced. Like I said, it held and went higher, held and went higher, held and went higher. So, you think to yourself, who wants to chase now that gap down, thinking this could be the day? I mean, it's just not an easy thing to do. So shorting the gap up is just, it's just much easier. And I think that the same thing flips on the buy side. Would you rather buy a stock that's just running away to the upside, or would you rather buy a stock that's, maybe a little bit lower, but maybe a little bit weaker, that has maybe a little bit more potential? It's just a risk reward.
Yeah, perfect. And I know you said you didn't trade this to what you wish you could, but what were your entries and general exits for this name here with SLV? And did you press as it broke below that first hour after that gap down on I think that would be the 30th or whatever that day where it really cracked?
Yeah. So, well, I have a lot of trades through SLV throughout, December and January, and I had some big wins and I had some big losses. I mean, I'll just go through the final week because that was kind of the climactic run. So yeah, I mean, right in here, this day on Monday in the afternoon, when it had one of its biggest moves ever intraday, and it started to reverse, I shorted it and I hit it pretty hard. And this is a continuation candle right here. And silver closed that day at the low of days and actually went down after hours. And I had some pretty good size there. I mean, I was very confident this was the end. And then the next day, it was not the end, so it kind of consolidated. Once you see this green candle right here on Tuesday, I completely exited that position, thought it's not worth it. It's not breaking down. It's not doing what I want to do. Fast forward to Thursday. I don't think I traded it Wednesday at all. Fast forward to Thursday. I absolutely hit this gap up, shorted it, had good profits right off the bat, only to have silver kind of bounce again, where I sized down into the afternoon. So I still was swing trading this. I did have a position on overnight, that I made money on that Friday, but I did not add. I added a little bit, but, a fraction of what I wanted to. And I made, just a fraction of what, the potential was for this. But again, when you're dealing with silver, you're dealing with a commodity, you can look at this chart and see that you're dealing with massive risk, gap risk, I'm sorry, every day. I mean, every day you're for the most part, it was gapping up, gap up. Now here's a gap down, but here's a big gap up, here's a big gap down. So when you're trading, futures or commodities, you have to deal with that gap risk. And, it's just tough. It's a whole nother animal. I don't trade commodities, really. I don't trade them. And this is kind of a new rule that I'm going to add. I'm not going to put it out there that I will never trade commodities again. I've traded oil and I've traded natural gas, but when I do that, it's with very small size. And I went into this trade trading large size, and only because I knew the potential reward that it would offer, but I was not expecting the toughness of the trade. I was not expecting, this final week to just have an up and a down and up and a down and up and a down and up and a down. And when it finally died, to be down 35% a day. So it was definitely a much tougher trade than what I expected. So going forward, if I trade commodities again, I will never let it take up several weeks of my focus, which I did. And I will trade it on a much smaller position size, because I know, hey, I don't want to risk this much mental capital on a trade again.
Right. Yeah. So Phil, I'd love to hear, if obviously you were stalking this SLV trade, did you go back and study the 2011 move to give you maybe some insight on how SLV might act? Because this one actually had some head fakes as well, which is interesting enough. So yeah, I'd love to hear your thoughts on this.
It is. No, it is. So it's something I do almost every ticker. Is I look at the history. Not only do I look at the daily chart, I want to look at the the history, 6 months, 1 year, and lifetime to see did it ever have a move similar to this before? Maybe even on a smaller scale, but how did it react? So yes, no, I did. I went back to the 2011 chart, and you can see right here when it peaks out, it falls on a day, it falls again, has a continuation day, but then it bounces pretty hard right back up to high of days, where this day right here is kind of a, it's a failed breakout before, the final peak again is right here on a Friday. And on Monday, we gap down very large and have, 4, red candles in a row all week. And that broke, and that's down, I don't even know, 30-ish% for the week. So, and I knew that with silver, that, the end could be tricky and would be tricky. And a lot of those setups are tricky. The hard thing, again, is to have on, meaningful position size and be able to hold through a bounce like this and another, failed breakout right there. So that's when it gets difficult, because, as I, explained earlier, one thing that's helped me throughout my career is to have strict loss management and be able to take my, cut my losses very quickly. So in something that's extremely volatile, it's hard to do. It's hard to say, okay, I'm going to cut my losses at just a few percent of my account. But at the same time, when I know they're volatile and they're going to have a wide range, it's like, okay, you're going to have to give or take or something here. So, it was difficult, but, going back through history, definitely is going to help out, because as we know and talked about before, chart patterns have a history of repeating themselves, and setups will do the same. So, any prior, chart pattern or something that you can find, it's, I think, going to help in the future.
And like you mentioned before, like you were looking at like the character of SLV. It would gap down and hold. Like you're getting a sense of the character of the instrument as you go through it.
Right.
Awesome, Phil. I know you wanted to cover MSTR as well, which is another great move in 2024 that both to the long side and then to the short side, which you took advantage of.
Sure.
So let's dive into that one.
Absolutely. So, MicroStrategy again was very similar to that SMCI setup for me. So you can see here in November, SMCI first of all started a big move down here, sub 150, went up to near 500 in just a couple months. So around this time, mid-November is when it kind of started to pique my interest. And once again, if you see this chart pattern, you have 3 big green candles in a row, 3 big up days in a row. This day closed a little bit weak, but on that 4th day, we gapped up very big. And once again, we gapped up, something around $525-ish. And after, 20 minutes after the open or so, we immediately started to pull back on higher volume, went below the market open that day. I started to take a position and continued to add to that position as it broke through 500. And I, took profits on this somewhere in the lower 400s, like 430s, I believe. I started to scale out 430s, 420s, 410s. Now, this stock did intraday. It did bounce a little bit intraday, and then it went and closed, made a new low of day at the end of the day at $375. And this is another really good example of playing both the equity and the options here. This move happened on a Thursday, but these options here went up, I know, well over 10x. I don't know exactly where some of them went. It's another, it was another trade for me. It was a 7-figure trade for me where I traded both the equities and the options. So, again, this is what I would consider an A+ setup, something right here.
For sure. And yeah, I love that 3 straight gaps up in a row and then another gap up to open and then the reversal after it's already extended. That's like this is the setup everybody should study if they're trying to become a good short seller.
Right.
A few questions for you, Phil.
Sure.
First, you've talked about trading both the options and common stock. And obviously options require additional skill, additional experience. There's additional risk there. How do you decide when you do that, how much you are trying to increase the potential of the trade with options? How do you kind of make those decisions as you're planning out a trade for something like this?
First of all, and again, buying options, it's something I'm not experienced with at all. Again, I do sell options for income quite frequently. This is the complete opposite, actually buying options. And we all know the majority of options expire worthless. They expire, worthless for zero. So, you have to have the mindset that you could, on a percentage-wise basis, lose more than you could on the equities because the options are going to move very fast. So again, on this final day here, if you are buying puts, which is what I was looking to do, if you would have, let's say you're buying puts at, $2, if you would have had any sort of a bounce in the stock, they could drop to $1.50 just, immediately. You could have a big percentage loss. Now, again, I'm going to trade less position size on some of these options. And the reason I do that is because they're leverage and that you have the potential to make, 5x, 10x, 20x, like we talked about in super micro, extremely rare, but 50 or 60x. I mean, and again, that's an extremely, extremely rare situation. So I'm going to play with less position size only because I know the huge upside that could come with that and the volatility that's going to go along with it. On the equities, I'm a little more familiar with, and I will, play a little bit more size on the equities than I will on the options.
When you're buying a put, how far out are you usually going? How do you kind of determine your strike price? How do you kind of lay out the trade just like that?
On a situation like this, I'm looking to do it extremely close. The super microcomputer, I did 0 days to expiration options. I just traded it that day because they were very cheap. And they are going to offer the most upside on this. This move happened on a Thursday. I was trading like the next day options and then 1 week out of options. I'm not going too much time frame further than that, and I'm trading, probably close to the money or a little bit out of the money, maybe 10% out of the money. And that's about it. So, the premiums are going to be a little bit higher on those. But that's what I, personally like to stick with.
For the options, like you said, like if it goes against you, the value of the option drops really quickly. Do you have like a stop loss rule for the option where if it drops 50%, 75%, you're out? Or do you just structure the trade in a way that you're accepting that loss on the full option, and even if it goes, expires meaningless?
Oh no, when I put on an option trade, I'm right back to looking at the equity, looking at the chart, and if I think the move is going with me, I'm totally fine to hold it. If I think that chart is going to hold and possibly reverse, or I think that my entry was wrong, I immediately get out of that option, take that loss off. I will never let an option expire worthless. I don't, I just never ever do that. So I cut my loss. 10%, 20%, could be 30%. But I, again, it's strictly off trading the chart, seeing where I think that pattern's going to go, and basing it just off that.
Perfect. That clarifies a lot.
Sure.
One question I had is more about routines, and routines are like my favorite thing to talk about, even though for a lot of folks it might be boring. But like, how did MSTR, SMCI, the SLV, what are you doing on a day-to-day basis to monitor for those types of situations? Like you said, there might only be 1 or 2 A+ trades a month. There might be none some months. So what are you doing on a day-to-day basis to monitor for those potential ideas? Are you running screens? Are you just looking through? What are you doing? I guess.
So a couple things. So first of all, if I get to my computer 2 hours before the open, I'm looking at the gap scanner. I'm going to know what's gapping today. What's gapping? Why is it gapping? What's causing something to move? And then I'm looking through, what I have on my radar from last night, but I'll get into just a pure day, waking up, looking at the gap scanner, seeing the gappers, seeing the news, figuring out why stuff is maybe moving, and then looking at, what has moved big the last 2 days or 3 days or 5 days are the biggest movers on this week or 2 weeks
Right.
period. So I want to see what's running, and put those all into my, my main monitor, and just continue to focus on those throughout the day until they will possibly break. After hours, I pretty much do the same thing. Do a post market follow up to see, okay, what were the movers today? How far did they run? How far do I think they're extended? Is there any news on them? Are they newsworthy? Is there something driving this move, or is this move purely, is it momentum or is it manipulation? Again, as a small cap trader, a lot of these moves happen through manipulation. Now, super micro and micro strategy or not, they're higher price stock, but I think a lot of those moves are just, momentum. And I think they're driven through momentum and probably driven through some greed. So I want to figure out why this stuff is moving. But again, I scan and screen constantly throughout the day if I try to figure out what's moving, what's extended, and why is it extended, to see if I have an edge on anything. And then like I said, I prepare every night for the next day. I kind of get a watch list of my top 3 or my top 5 stocks. I don't like to have there's nothing wrong. It all depends on your style. With my style, I don't want to have a watch list of 20 stocks. I can't do that. I want to focus on ideally two to three top setups that I have laser focus on, and that I'm willing to say, okay, if this develops into an A+ setup, I can put on position size. I'm not able to put on big position size on 3 or 5 or 7 or 10 stocks. I want to do that on, 1 or 2 or just a couple of them. So, I go into every day, like I said, with my watch list from the night before, my new watch list from this morning. I've compiled that with hopefully my best 3 to 5 setups for the day, put them on my main monitor, and just wait for the open.
Excellent. And to dive deeper into that, let's say you do your screening and you find 2 ideas that are similarly set up. They're extended, they've got the qualities you look for, recent gap ups, they could set up a good short sell. What are the nuances that might make you go for one stock versus the other, like market cap size, the size of the prior move, the character of the stock? What are those little details that might separate B+ setup from a triple plus setup for you?
So market cap is one. You want to see how thinly traded is it. How low is that float, and liquidity is another one. If you're going to take on position size, I want to make sure something that is highly liquid that I can get out, get in, and more importantly, I can get out if I need to. Last thing I want to do is short something really illiquid where one uptick can halt the stock and you're halted. You don't want to mess with that at all. So liquidity is number 2, and then really just the extension of the move. How extended is something? What is the risk reward on this setup? So yeah, that's great. And then fourth, like I said, 10% is fundamental analysis. I'll dig a little deeper into the move. Like, why is it happening? What are the financials of the company? Do they need to get raise money or do financing? To try to put together, my overall thesis. And then again, looking at the chart, looking at the historical move of the chart, did this move have something similar in the last 6 months or 1 year or 3 years or 5 years? And, those are probably the main categories, but I would say, volume, liquidity, the float, and the extension of the move. The extension of the move really tells me my risk reward potential on it.
For float, I assume lower is what you prefer. Do you have kind of a rule of thumb number that you kind of look for?
Lower is not something I prefer, because again, the lower the float is, the more volatile you're gonna have. So as the small cap trader, sometimes you might look at a stock with 1 million share float or 2 million share float. I don't even trade those anymore at all. I don't mess with those whatsoever. They're too thin. They're too manipulated. So I would like to have something with at least 5-10 million shares traded, at a minimum, to make sure that there's, ample liquidity to get in and get out of positions that you need to do.
Yeah, and in a similar vein, so what average dollar volume or average just shares traded on a day are you typically looking for to make sure that you're not going to be stuck in a position that goes against you? Do you want to be a certain percentage of the average? Yeah.
No, that's a good question. Again, that it's all that's going to help determine your position size. I mean, I've had small caps that are trading 1 billion shares in a day because they're, the algos followed them and the momentum followed them, and that's the hot stock of the day. And you can trade ample position size there because you can get in or out. If something's only trading, 5 million shares of a day, that's very, very thin, and there's just no way you're going to put on the position size with that stock, because that, there's big potential risk of, being stuck and not being able to exit when you need to exit.
Yeah. And talking about the 10% that's fundamentals, you talked
Mhm.
about diving into why is it moving. Are there catalysts that you found are really good, catalysts that eventually become good shorts? Like, is there a situation that you love to see that
Yeah.
are okay? This move is driven by X. This is likely going to be a high potential trade for me when it
Yeah,
breaks.
and that comes with being familiar of reading press releases of small caps to know when you decipher the actual, legitimate press release versus the BS. And
Mm-hmm.
here's a good example. So back in COVID, what was every biotech company trying to do in, like March, April, May, June, July of 2020? Everybody's trying to create a vaccine. So all
Right.
these small cap companies were putting out press releases. We are trying to create a COVID vaccine. And you can go through the history of where they tried to cure, Ebola and failed, and they tried to cure the bird flu and failed, and they tried to even maybe create a flu vaccine and they can't do that. You're like, okay, this company has 4 employees, they have no cash, they have a history of putting out press releases that they're trying to cure numerous common diseases, and they haven't been able to do any of that. So the likelihood of them being able to cure COVID is literally zero. So that's where my fundamental analysis comes into play. Like, this is bullshit. The fundamentals are garbage. But again, the technicals, that's why I have 90% technicals, is that we've seen fundamentally crappy companies just run up to highs that nobody thought was possible. I mean, GameStop is a great example. I mean, there's no fundamentals, but you got to trade the chart, you've got to trade the trend. So I want to keep, that 10% of fundamentals in my head, knowing, okay, this is the situation, and then it goes into strictly reading the chart, trading the trend, and going from there.
Yeah, we have a saying in our style, we buy based on fundamentals and technicals, but we sell only on technicals, or we manage the
Yep.
trade only on technicals. And if the technicals don't match your thesis, that means the thesis isn't applicable right now, even
Right.
if it ends up eventually being true.
Right.
Um,
Absolutely.
cool. One question I had for you, and this is a question a lot of people had, is what issues have you run into with the short sell strategy when it comes to scaling your portfolio and trading a bigger account?
Yep.
Are there limitations you've had to adapt your style a little bit?
Yeah.
And how have you kind of need to find new edges
Yeah.
as your account has grown and you're not able to because obviously we've talked about liquidity being an
Mhm.
issue, the float being an issue. So what adaptations have you had to make as your portfolio has grown?
Yeah, so that's the hardest thing with short selling and short selling small caps, is the liquidity and the ability, the inability to almost scale. So again, I have kind of adapted a little bit more the last several years to an option trader and an option seller, because I can scale that, and a little bit less on the in the short selling side. And the issues that I've run into are just that. I mean, you can only grow so much when you're, betting on cheap stocks to go down, right? I mean, they
Right.
can't go below zero. So, what percentage gain can you make on these? So, the other thing that has kind of thrown up a red flag are some of the wild, crazy moves that we've seen some of the last few years, and especially some of these, cheap Chinese scams, almost stocks that could run from $100 to $1,000 even after hours. I mean, and some of these things. So liquidity is huge, and something that was tougher several years ago, it's gotten easier now, is the borrows. I mean, you have to understand, if you were shorting a stock, you have to have a borrow. You have to find a locate, and that's not easy to do. And some brokers have great locates, other brokers don't have any locates. I mean, other than on large mega cap, thickly traded stocks. So you have to have a locate. But, I think, yeah, I mean, scaling is something that's almost impossible to do. I mean, you can't, you can only get so big when your strategy is to just short small caps, and that's it, right? I mean, there's a limit to what you can make, because again, you have to watch your risk. You have to watch the other side. I mean, you can't just
Right.
go all in on everything, because when you need to exit, there is no exit sometimes with thinly traded names. The examples I gave, the MicroStrategy super microcomputer, the reason those are really A plus for me today is because they're thickly traded,
They're
higher
bigger.
price, major volume, major liquidity. Take any
Right.
position size you want. You can get out in a second if you need to. So with the smaller caps, that's just not the same size. So my hope is, I'd love to see more of these, moves in the higher price stocks for sure, just because they're is easier, they're safer, and yes, you can make, I would never say unlimited money in these, but you can make the upside is so much bigger on some of these large cap stocks than it is on small caps.
And it sounds like also you've kind of looked to develop more edges or more strategies. For instance, you mentioned selling options for
Mhm.
income. That's one thing you've tried. I know. I think in previous interviews that I've watched, you have been in trying a little bit more to the long side, momentum, swing trading a little bit. So yeah, could you talk a little bit more about the option strategy? Obviously, this is more advanced. There's
Yeah.
stuff you have to consider, but I'd love to hear a little bit more about that as well.
Yeah, so I started trading options almost 10 years ago, and I instantly was kind of hooked selling options. It's not something I talk about a whole lot because it's very dangerous. I mean, it's a dangerous method, and I sell a lot of naked options. I do some spreads, I do some coverage, but for the most part, I'm selling naked options way out of the money on 50 or 60 different names. Basically, I want to sell puts on stocks that have big relative strength, in a good uptrending market, right? Um, that's kind of the overall strategies. I want to sell puts on strong, good, profitable companies in a bull market, and we've been lucky enough to have a bull market for quite a while now. Again, when does that
Yeah.
end? When does that change? I don't know. But the options, yeah, it's definitely it's a highly advanced strategy. It's not something I recommend. It's not something I talk about at all. I do discuss a little bit, in the Market Wizards book that comes out in June, but it's definitely not for somebody new to trading whatsoever. As far as the long side, I've been kind of trying to adapt for years. I don't have any problem finding momentum stocks, right? I mean, we can pull up a
Yeah.
screener, we can see what's being bought, we can see, the strong companies with good fundamentals in a good industry. The hard part for me is saying, hey, I want to hold this, 60 days or 90 days, and I have a hard time holding it past a few days because I have that kind of day trade mentality. It's just I'm used to taking profits quickly. So when I see profits get away from me, or if I see, what I think is the trend turning or the tide turning, I sell way too fast, only to have it continue its uptrend a couple days later. So it's definitely a flaw in my trading I'm trying to learn. But again, I think, it's good to adapt as a trader and try to change and try to learn new methods, which is, what I do, or have done. It's just like we talked about before, you gotta limit your position sizing on that stuff.
Yeah. Excellent. Phil, this has been great. I just have a few quick wrap up questions.
Sure.
First, this is, again, one of my favorite questions to ask. And I think your perspective as someone who trades options, short sells, this would be really interesting. If you had to explain what managing risk means to someone who has never traded anything like that, what would you say? Basically, how would you define what risk is in the markets, and how do you define that for yourself, and how do you manage it as well as a trader? Because that's really our job.
I think your risk is your capital that you're willing to put up, whatever that amount is. For me, it was $3,000 in college. Now, I was willing to risk that. I didn't lose it overnight. I slowly lost it over like 12 months, but um, because I knew the potential upside. So your risk is at any given time the capital and the amount that you're willing to part ways with. And it's parting ways with your capital is one thing, but again, it's how you can handle that mentally, and
Yeah.
that's how I think so many traders differ. Some active day traders can have massive swings in their account, 30%, 40%, and they can come back the next day and be like, fine, no big deal. I'm gonna, for me, I just, I cut my losses immediately fast, 5%, 10% max, and that's it. And you know, trading, one of the hardest concepts I think for traders to realize, and I've traded 20 years, and is that how hard it is mentally and how much the mental side of trading really comes into play. We can all look at trends and we can all look at A plus setups and we can all say, I know this is a setup. If I see this again, I can make money on that again. But it's like, what do you do in between all that time? I know how do you handle all that downtime and how do you handle the the mental toughness side of, losing money and losses. So, um, your risk, yeah, it goes along with all that, your financial capital, but again, your mental capital, because if you're not mentally tough and mentally ready to trade the next day, you shouldn't do it. You shouldn't sit in front of your screens unless you're really mentally, ready to go and prepared.
Yeah, excellent. And I think you've talked a little bit, you've mentioned a little bit here, wiring out money
Mhm.
regularly has helped you immensely.
Yep.
You do a lot of alternative investments that grow your net worth outside of trading. And I
Yes.
think that comes back to the mental capital too, is your trading account, you're able to be more risky with that because you're set up securely in other ways financially. And I think that's operating from a position of confidence is the only thing that really works as traders. When you're operating, like you said, from a mindset where I need to make money, I need to
Yeah.
pay this with that, that's going to be where you force things. And instead of having the luxury of waiting for the A plus trades, like we've talked about, that might happen once a month, once every 3
Right.
months, whatever it happens. So yeah, that's huge. Anything you'd like to elaborate on there, or
No,
I
that
think you
you hit
shared
the
a
nail
lot
on the
already.
head.
Yeah,
Again, I'll go back to my senior year of college. I turned 5,000 to million, lost 500 grand, and I put 400 in the bank and I traded with 100. And putting
yeah,
400 in the bank was like the instant, like, hey, if I don't see a trade today, I'm not going to take it. And that gave me the comfort, and that comfort has continued to grow for the last 20 years. Putting in, like you said, I have a lot of alternative investments, that just continue to grow. I'm very fortunate with that. I could have compounded my accounts. Maybe I'd have more today, but I don't think I would. I don't think I would have slept nearly as well the last 20 years. So, yeah, I mean, when you can come into the market every single day with a free and clear mind, you're going to trade better. And I think not, you hit the nail on the head. You don't want to feel forced to trade. You don't want to feel forced to make money because you're going to do things that don't fit your plan. And that's the thing. I think traders, again, we need to have a plan. This is what I do. This is how I make money. This is how I succeed. And you need to just stick with that plan. And when you deviate from that plan because maybe your mind isn't right, your thought process isn't right, that's where you're gonna make mistakes. It's common. I've done it many times over my career.
Excellent. Well, Phil, this has been really amazing. It's so awesome to get to learn from your experience. Just one last question for you. What advice do you have for traders earlier in their journey? Maybe a few years in, they're trying to still develop their style. They're trying to figure things out. Master risk management. Learn how much to position size. All of that. What advice would you have to kind of point them in the right direction? Obviously, everybody, someone might be trading a different style than you, but what kind of advice or motivational, words can you offer them to help support them in their journey?
I think, new traders have to realize that most traders I've talked to, including myself, have to go through pain. And, I went through a lot of pain, or paying your tuition, whatever you want to say, for several years before they can get to be profitable. So that's part of the game. I mean, you can't get down. You can't have false expectations. Don't have expectations that, you can blindly follow some people, or just have a mentor, and all of a sudden now you're going to be profitable, and now you've learned it. Now you get it. I mean, there's nothing that can replace experience. There's nothing that can replace time in front of the screens. There's nothing that can replace real trading, real experience. And again, that's going to be number one, putting in the time. I don't know of a shortcut other than putting in the time, putting in the experience. And number two is, it's so important to analyze your trades, look at your trades. Look at where you're making money. Look at where you're losing money. Look at what time of the day you're making money. Look at what time of the day your biggest losses happen. Study your biggest losses. Know what did you do the night before? Did you drink too much? Did you go to bed too late? Did you have some event happen in your life? Maybe a death of a loved one, or whatever that might be, where you say, "Wow, I didn't trade that well that day because I did this or this or this," and take notes of that. Take mental notes. I mean, you have to, you know any corporation, big corporation, what do? They study their data. Data is a very useful, important thing. And as traders, study your data. Know when you're profitable, know when you're not profitable. And for me, that just helped so much open up my eyes into, wow, this is when I'm good. I know I'm good and profitable, really profitable the first hour or so of the day. During the lull, the next couple hours, it's kind of like, not a big deal. I'm profitable the
Right.
last hour or two of the day. So, and every trader is going to be different. So don't get discouraged, realize that you're going to have to put in your time. Um, and just be willing to just keep learning and keep going and studying the data. Those are the things that really help me, and I think those will help a lot of other traders too.
I love that about studying your worst losses, because
Mhm.
that's where a lot of the gold is. Where,
Yeah.
like you said, one thing that really helped your performance was cutting out those C and D trades
Yep.
that were dragging everything down, and
Right.
just playing better defense,
Yep.
managing risk better, can dramatically shift the performance. Do you do kind of an annual review every year, or how often do you kind of look at your data and see if you're on track and everything like that?
I do a mental review every day. Every day I do a mental
Mm-hmm.
review. What did I do well? What did I do poorly? How was the market overall? How did I feel today? I literally, now it's mental every day. Monthly, quarterly, and annually, yeah, I definitely get into my trades, do a much deeper analysis into everything and kind of figure out, constantly, as a trader for 20 years, I'm every year constantly trying to tweak and upgrade, cut this stuff
Yep.
out. This doesn't work. Use more size here, use more size at this time of the day, cut your losses faster here. Maybe don't trade, like we talked about silver, commodities again. I'm not going to do that. I'm not going to put in the mental capital with a commodity again, as I did with silver. That's a great learning experience. I mean, I didn't need to wait till the end of the year to learn that. I knew it, as soon as that trade was done, not going to do this again. So I think, constantly reviewing yourself as much as you can is only going to help. It's only going to help you. So as frequently as you can, minimal once a year. I mean, that's the absolute bottom, amount of time is every year. But again, it's how much do you want it? If you want it hard, yeah, analyze them monthly. It doesn't take that long. It's not going to take up that much time. I mean, that's what the weekends are for. The markets aren't open. Spend a little bit of time on the weekend to learn these things.
Awesome. There's always something to learn, always something to improve on.
Yep.
Phil, this has been fantastic. I've really enjoyed it. Thank you so much for your
Yep.
time. To everybody watching, I hope you guys did as well. Probably you want to watch this multiple times and take more notes. But Phil, thanks again so much for coming on. To everybody watching, again, hope you enjoyed. Subscribe if you're new to the channel, and we'll see you guys in the next one. Cheers,
Thank you,
everybody.
Richard. I appreciate it. Take care, buddy.
Thank you, Phil.